This is the first tutorial of the Quantopian Getting Started playlist. To start with, I'm a computer science major with a very little knowledge of finance, so please feel free to expand on any topic you need in the comment section. Let's start with what is a trading algorithm. It's basically a set of rules defined by us for buying or selling assets. And how does one develop a trading algorithm? Take a historical data, apply a statistical model, and develop a set of rules from the results obtained. So, how do we start with it? We have the historical data provided by Quantopian. So all we need to do is to find a statistical relationship based on our strategy. So let's just start with coding a few things. So for using Quantopian, you have to log in, and after logging in, you have to click Research and Notebooks. Once you're there, you'll see IPython notebook. And for people who are very new to Python and don't know what IPython notebook looks like, this is what IPython notebook is. And these are the cells which you can add. Also, these cells are useful when you want to execute a little part of your Python and not the whole Python file. So if you want to execute, for example, the second part of your Python file, just click here and press Shift Enter. So now we don't need all these cells. So let's see how to plot the daily close price of Apple along with the 20 and 50-day moving averages. What is a moving average and how do we use it in a trading strategy will be covered later in this tutorial in the same video. So let's first start with importing libraries. So let's start with first importing the prices and the symbols function provided by Quantopian Research. So once we import the prices symbol, let's import pandas as it's very important library for data manipulation. Once imported, let's start with allotting a variable for close prices. Let's use the function prices. And if you want to know what are the parameters of prices, the function will import it from Quantopian Research. Just go here, click on API reference. So the functions and the APIs provided by Quantopian is listed here. And if you want to see what the prices consist of, it's in the research environment API. So it wants assets start and end, frequency, price field, symbol reference, date, and start offset. So let's just use this. So what do we first need is assets. We want our asset to be Apple, so we'll use symbols library, symbols function. Then we'll be using start date as the date we want to start getting the data from, which will be 2013. And of course the end date, we'll take it at 2016. Once done, let's see if it works. Yeah. Second, let's calculate the moving averages on Apple pricing data. So we'll be using the rolling function provided by Python. What rolling function basically does is it provides a rolling window calculations. So here we need the window to be 20 as we're calculating the 20-day moving average. So let's click 20, let's select 20 and we want to find the mean, right? We want to find the simple moving average. Similarly, we'll do the same for the 50-day moving average. Once this is done, we'll now create a data frame. So now we have created a data frame. We want the columns to be the closing price, the 20-day moving average, and the 50-day moving average. So let's define the columns. You can just plot this with the title Apple closing price versus the simple moving average. So this is what we get. So what is the moving average? They are basically to make trends stand out. There are three types of trends. One is the uptrend, where the price is moving higher. The downtrend, the price is moving downward, and a sideways trend. There's something called bull and bear in stocks. So when do we say that the stock is bear? When we expect the price of the stock to go down, it's called as a bear stock, and when we expect the price to go up, it's called a bull stock. So there are three types of moving averages. One is simple moving average, the exponential moving average, and the weighted moving average. The difference between the simple moving average and weighted exponential moving average is in the weighted moving average, more weight is given to the recent prices, thus it adapts faster to the change as compared to the simple moving average. So how do we invest using a longer period and shorter period of moving average? Consider an example where dean has to send information to students. So the first one to get it will be professors and then the students, right? Similarly, here the simple moving average for a shorter period, that is 20 year, adapts faster to the price change as compared to the longer period moving average. So the trading strategy we can use for the simple and moving averages, when a shorter period moving average crosses above a longer period moving average, implies the trend is changing to upside and it may be a good time to buy. Let's see here. So as you can see here, this shorter period, the moving average for a shorter period is crossing the moving period for the longer period, moving average for a longer period. Thus, this is a good time to buy because the 20-day simple moving average is telling us that the trend will increase. So we buy here, but when the shorter period moving average crosses below a longer period moving average, it implies the trend is going downside and it may be a good time to sell, which we can see here. The simple moving average for a 20-day crosses the 50-day moving average. So the 20-day now knows that the stock price will decrease. So this is a good time to sell. As we all know, we need to buy low and sell high. Also, I'll post the links for the simple moving average concepts and how is it used for investment strategy in the description below. So please feel free to have a look at it. Thank you.